All right, let's get into this. We're about to break down one of the most common and most frustrating mistakes in all of investing. And what's really wild is that the answer involves a surprising connection between our own brains, artificial intelligence, and, you won't see this coming, the weather. Come on, you know the feeling, right? You've got a stock that's finally in the green. You sell it, lock in that little win, and then you just watch in agony as it shoots to the moon. And at the same time, you've got this other stock that's just bleeding red ink day after day, and you just hold on, you hope. It feels like a personal failure, but it turns out this is a universal human puzzle. And this puzzle, it actually has a name. It's a behavior that's so common, so predictable, yet so completely backwards that it's become this huge paradox for economists and psychologists. And here it is. It's called the disposition effect. Basically, we are way too eager to cash in our winning lottery tickets, but we refuse to throw away the losing ones. It's like you're in your garden pulling out all your beautiful flowers, but you're carefully watering the weeds. A lot of researchers think it comes down to a simple fear of regret. Selling a winner feels good. It's a solid victory. But selling a loser? That makes the loss real. It's admitting you made a mistake. And listen, this isn't just some minor little quirk people have. Scientists have been studying this for decades, ever since the 80s. They call it one of the most robust, meaning solid and repeatable, puzzles in the entire field. It's a powerful and often really expensive bias. But that leads us to the billion-dollar question. Is there actually some hidden logic here we're not seeing? You know, maybe people hold on to losers because they genuinely believe those stocks are more likely to bounce back. Or is it just a bug, an emotional glitch in our human programming? Well, to figure that out, you need to compare us to something without emotions. And this is where things get really interesting, because today, we can put human decision-making head-to-head with its perfect, emotionless counterpart, trading algorithms. So on one side, you've got us, humans. We're running on gut feelings, fear, greed, what we had for breakfast, you name it. And on the other side, you have these AIs that just run on pure code and cold, hard rules. They don't get excited about a win, they don't get scared of a loss, and they definitely don't have an ego to protect. This makes them the perfect control group to finally isolate what's really causing this disposition effect. Okay, but how in the world do you actually measure something as messy as human psychology? This is the tricky part. But some researchers from Norway's central bank came up with a genuinely brilliant solution. See, what they needed was some kind of outside influence, something that would mess with a human trader's head, but that an algorithm wouldn't even notice, something that changes our mood and how we think without changing a single thing about the actual stock market. And this critical piece of the puzzle wasn't buried in a financial report or some economic forecast. Nope, it was literally right outside the office window. Yep, the weather. Now, I know it sounds a little weird, but stick with me. There is a ton of research out there showing a clear link between things like sunshine and temperature and our mood and even our ability to think clearly. It was the perfect natural experiment. So the theory went like this. If this whole disposition effect thing is really a psychological flaw, then we should see it get worse for human traders on cold, gloomy days, when people are feeling a bit down. But for the trading algorithms, the weather shouldn't matter one bit. A cloudy day is the same as a sunny day to a line of code. It was the perfect test. So what did they find? They took years of trading data from the stock exchange in Copenhagen and matched it, hour by hour, with the local weather records. And the results? Well, they were about as clear as you could possibly get. This number right here is the smoking gun. On colder mornings, the disposition effect, that tendency to sell winners and hold losers, was a massive 28% stronger among human traders. Think about that. People were significantly more likely to make this classic mistake just because it was a bit chilly outside. When you look at the chart, it's just night and day. For humans, the bias went up and down with the weather, clear as day. And for the AI traders, nothing. A completely flat line. The effect was zero. Their trading was totally immune to the weather, exactly like the researchers predicted. So, the verdict is in. This is some of the first hard evidence from the real world that this expensive bias isn't some kind of hidden strategy. It's a bug in our own psychology, and it can be triggered by something as simple as the morning temperature. But wait, the story has one last little twist. So here's the cool part. Some of the most advanced AIs, the ones used in high-frequency trading, do actually show this same pattern of selling winners and buying losers. But for them, it's not a mistake. It's the whole point. They're deliberately programmed with what are called price reversal strategies. They are designed to systematically buy stocks after they dip and sell them after they rise. For the AI, it's not a bug, it's a feature. So what's the big takeaway here, beyond just the stock market? Well, the implications for the future of how we make decisions and who makes them are actually pretty profound. What this study is really telling us is that AI decisions line up much better with our traditional economic models, the ones that assume everyone is a perfectly rational robot. As more AI gets into the market itself might start acting more rationally. But that also means that in any industry that needs cold, hard logic, humans might get replaced even faster. Which leads to a huge question: what does that do to us? Do we get better at making decisions by watching them, or do we just let our own mental muscles get weaker? The author of the study, Karolis Leondinskis, puts it really bluntly. He says that as AI replaces humans, our old economic theories might finally start working. Not because we got smarter, but because we're being taken out of the picture. We've just seen a crystal clear example where our own minds lead us astray, where a machine with no emotions, no ego, not even distracted by a cloudy day, simply makes the more logical move. As this kind of technology gets everywhere, it forces us to ask a really fundamental question. In a world that's being optimized by rational machines, what's left for good old-fashioned human judgment?